welcome to the Morningstar series Ask the Expert. I'm Emma Wall and I'm here today with Morningstar analyst Pete Brunt to talk about a new fund that Morningstar analysts are rating. Hi Pete.
Hi Emma.
So what is the new fund that analysts are rating?
So we've relatively recently added Schroder Global Recovery to our coverage. Actually two versions, an onshore and an offshore version of that global strategy.
And what is it about this strategy that Morningstar analysts like?
So the fund is managed by a team that we know well from a UK-focused strategy, the Schroder Recovery Fund. They've been running it since 2006, two managers, Nick Kirridge and Kevin Murphy. They have a very strong track record on that mandate. And actually within the UK category, they do have an allowance to invest overseas. And for some time, they have been using that allowance. They're allowed to go up to 20% in non-UK equities. And they've been using that allowance. So they do have some experience in looking further afield. And they took the decision in 2013 to launch a global fund. And, you know, that's really using the same process that they've been applying on the UK strategy. They've broadened their resources somewhat, so they have a bit more analytical capability backing them in terms of analysing the companies. And we've really taken the view that they because it's so process-driven, they don't actually need to have the biggest team in the world to do what they're doing.
And they are a value-oriented strategy, aren't they?
They are. So they're quite unique in that they are one of the few really genuine, pure sort of value-driven investment managers that we cover. Their approach is looking at companies that are trading significantly below their cyclically adjusted earnings. So that's typically looking over a 10-year period. And what sets them apart, or maybe perhaps what we feel makes them better than the rest, is their implementation of that process. You know, they're really able to identify companies that are not going to be value traps. I guess one of the risks in value investing is that you're investing in companies there that the price is correct, that the company is not that great. And what we feel they've got an edge is their ability to kind of filter out these false positives and really pick the companies that will have a strong recovery.
There are some examples of fund managers moving from one region or sector to another that haven't been a success. This has been a success, and there's another example of a UK manager moving into the global space that has been a success and that Morningstar analysts have recently rated.
That's right. So we've also added Lindsell Train Global Equity to our coverage. This is again a team that we know well. It's the combination of Nick Train, who we know from his UK equity fund, and Michael Lindsell, who also runs the Japan equity fund. And they combine forces really here for their global equity fund. Unsurprisingly, there's a bias to both of those regions within that portfolio. And again, our confidence is really underpinned by the strength of the process. They have a very prescriptive way of analysing companies, and it really whittles down the investment universe to quite a manageable number. So they don't have a big team either. They have a small team of analysts backing them up. They also have another third fund manager on the global strategy too. And you know, there are similarities between those two portfolios in that they're both quite concentrated, they're both unconstrained, so they're going to look very different from the benchmark on a geographical and on a sector level. But they are actually sort of diametrically opposed in terms of investment style, where the Schroder fund would be really investing in sort of deep value names. With the Lindsell Train Global Equity, it's at the other end of the spectrum. They're targeting really high quality companies that typically trade at higher multiples in the market. and they operate a buy and hold strategy. So they look to find companies that have very easily defendable business models, very strong franchises, little need for debt, and they look to hold them forever, ultimately. So they're very different in terms of their approach, but in terms of the fact that they both come from the UK, and Lindsell Train's case from Japan as well, they're similar.
Pete, thank you very much.
You're welcome.
This is Emma Wall for Morningstar. Thank you for watching.